Well, I try not to do too much because there are a lot of uncertainties, as you mentioned, and we have these day-to-day fluctuations. I mean, we don't feel good today because the markets are down, but we felt really good yesterday and the markets were up. And we're kind of like hostage to Russia and Ukraine headlines, inflation, of course, and then the Fed, right? They're the same three things. We keep on rehashing those, Sarah. The good news about, there is only a good news about Russia-Ukraine is that history, from an investment point of view, is on our side for the long term. The markets can recover, and I think eventually we will. We'll have to see how long this goes, but eventually the markets will recover. And in terms of inflation, wow, those numbers were hot. I know they were just in line, but 7.9% CPI and 4.7% on rents. That is actually, and that number's going higher according to the Dallas Fed to 6.5% for at the end of 23. So that's something that's worrisome. And of course, the Fed, can they engineer a soft landing? Whether they do 4 hikes, 7 hikes, 10 hikes, I don't think that's really going to materially slow inflation, unfortunately. So we have these things that we're dealing with. And so that's why I kind of tend to just kind of put the blinders on, focus on fundamentals, focus on quality companies, good free cash flow stories, valuations matter. And that's, I can kind of pick away. I'm not taking big sector bets at this point because of the uncertainty. But I mean, I'm trying to find some ideas into these weekdays.
Well, speaking, Steph, of the interplay of valuations and fundamentals, I mean, all the decline so far, 12% in the S&P, 20% in the NASDAQ, has been a relieving of valuation multiples, right? In other words, the earnings forecasts have continued to go higher, at least a little bit, on the index level. So it's not necessarily about a radical downward revision of profit outlooks. However, to what degree, do we have to be bracing for that? If you look at the leading indicators of earnings revisions and things like that, are we going to be in for a round of, of downward revisions that we have to absorb into the market as well?
That's the magical question, Michael. I would think that there are going to be companies that don't have pricing power that are going to struggle a bit. I think that those are the sectors that you're seeing. I mean, you wouldn't expect, say, for example, the consumer staple stocks to be really weak, but they are really weak. A lot of them have international exposure, a lot of European exposure, and they do have some pricing power, yet, of course, they're going to be hit on the demand side and demand destruction side of things. So it's kind of strange. You're going to have to go sector by sector in terms of where we think the numbers are coming down. Ironically, I think the numbers are not going down in technology, and they're the ones that are getting hit the hardest. That's why I've net been adding to the technology sector, because I've been underweight, as you know. But you're right, where we went from 21.4 times earnings on the S&P to 18.7 times. Who's to say we can't go to the average, which is 16 times? We could. Right. So that's why you have to make your shopping list.